Welcome, dear traders. You are watching a recap of the Asian session on July 28. Today is a Friday. InstaForex analysts are ready to sum up the results of the trading week, which has been loaded with events. In the last 3 days, 3 major central banks held their policy meetings and issued forward guidance for the nearest months. It seems that policy decisions of the Federal Reserve and the ECB signaled that the most aggressive cycle of rate hikes this century is coming to an end soon. In the Asia-Pacific region, investors cheered the decision of China's authorities to bolster the flagging domestic economy. The fresh economic data also had its impact on the sentiment in global markets. As a result, the Asian stock indexes went down today, following the dynamic on Wall Street. The landmark event in the Asia-Pacific region was the policy meeting of the Bank of Japan. Before the meeting, Finance Minister Shunichi Suzuki said that the cabinet was closely monitoring policy decisions of the US Fed and other central banks. Commonly, such comments preface forex interventions by Japan's monetary authorities, who aim to safeguard the national currency. And today, the Bank of Japan maintained its ultra-low interest rates as expected. Importantly, the central bank's rhetoric had a touch of a hawkish notes. Japan's central bank raised the threshold of a 10-year government bond yields. From now on, its upper limit shifted to 1% from a 0.5%. Besides, the regulator again admitted that there is still a long way until inflation is pushed down to the target of 2%. This statement was made even tough. The core consumer price index for Tokyo declined in July. The core CPI slipped to 3% on year after 3.2% growth in June. On the other hand, inflationary pressure in Japan has been mounting for 14 months in a row. The odds are that the Bank of Japan will have to fine-tune its ultra-loose monetary policy this year, on the back of stubborn inflation and aggressive tightening by other central banks. The hawkish tone in the Bank of Japan statements was bearish for Asian stock indexes and encouraged the yen to assert its strength. The yen even managed to test its one-week high, or at 138.05 against the US dollar. However, markets are getting ready for the hawkish revision in the Bank of Japan's policy. The issue of interest rates was brought up in the Nikkei periodical published a few hours earlier. So the market immediately response was muted. Nevertheless, the yen traded actively in the Asian session today. In the daily time frame, the dollar-yen pair first jumped to resistance at 41.08 and then sharply dropped to 138.05. At the end of the session, the instrument climbed again and settled a bit below 140 yen. At this stage, it's unclear if the yen will be able to consolidate below this level, and the next technical support is seen at 137.40, the lowest level since May 19. Alternatively, the dollar-yen pair could encounter resistance at 142, the highest level of the last Friday. The US dollar also made sharp price moves in Asian trade today. After a brief consolidation in the corridor between 101.60 and 101.80, the US dollar index expanded its intraday range between resistance of 102 and support of 101.60. The US dollar owes its strength to upbeat economic data from the United States as well as rising yields of US treasuries. The statistics showed yesterday that the US GDP expanded by 2.4% sequentially. Moreover, durable goods orders were beyond the consensus. Last but not least, weekly initial unemployment claims fell to multi-month lows. This data provides the Federal Reserve with the leverage to keep its hawkish settings of monetary policy. Thus, yields of 10-year treasuries were steadily growing, pushing the US dollar up. All in all, the US dollar index rose across the board in Asian trade to 101.90. The greenback is on a track to close the week with gains for the second week in a row. The Australian dollar was the most vulnerable to the greenback's advance. The Aussie weakened not only because of strong US economic data and the firm American counterpart. The Aussie was hurt by soft factory inflation in Australia. The producer price index rose by 0.5%. The index was the lowest since the first quarter of 2021. Though inflation is still lingering in Australia, inflationary pressure has been ebbing away. It means that the Australian regulator may not find it appropriate to venture into another rate hike at the next meeting. In this context, the AUD-USD pair took a nosedive inside the intraday corridor between 0.6622 and 0.6715. Finally, the instrument closed the Asian trade in the red at 0.6643. The other antibody currency, the New Zealand dollar, is trading with the same dynamic. The kiwi has been weakening for 3 sessions straight. In the early Asian trade, it fell to 0.6140 against the US dollar. And today, the kiwi is especially insecure amid the recovery in the US dollar. On the 1-hour chart, the NZD-USD pair is sleeping lower without any resistance within the intraday corridor between 0.6121 and 0.6195. The kiwi is expected to close the week with a 0.7% slide against the greenback. We hope that you will complete another gainful trading week. Welcome to leave your feedback and comments and stay tuned.